did last time in regards to accounting cycle is doing some recording some transactions which the owner provided $100,000 as initial owner's capital to invest in the company. That's the equity financing that we have, $100,000. We did the journal entry and we posted in the T account. Then we purchased equipment. Then we paid for utilities. We paid also prepaid for rent for 1 year. And we received cash from a customer to do a job down the road. And also we have a withdrawal of $12,000 by owner. So we record all those and we post them in the general ledger. We have all this cash, T account, capital, equipment, utility, prepaid rent, revenue, unearned revenue, withdraw, and so on and so forth. So now, what we did next, we created a trial balance, which is a balance of all those T accounts in here, just to make sure what we have, how much, and where it is. In a trial balance, the first number needs a dollar sign. The rest, they don't need dollar sign. Here we go. And again, at the bottom, both sides are equal, which is combination of debit side and credit side. That means so far, whatever I did, debit, credit, looks good. In regards to accounting equation, I also show you how accounting equation looks like, which is, understanding that asset equals liability plus equity, and all my assets on the left-hand side of equation equals to all my liabilities and equity combined on the right-hand side of equation. And I told you that there's a account number for every account. All assets starts with 1, liabilities starts with 2, equity starts with 3, withdrawal starts with 3 again, revenue starts with 4, and expense, if it's a cost of goods sold, starts with 5, it's a regular expense, starts with 6. And also I told you that there are normal balances that you need to learn. The normal balance for asset is debit, for liability is credit, for equity is credit, for withdrawal is a debit, normal balance, revenue normal balance is credit, and expense normal balance is debit. That means if you debit, let's say asset goes up. If you debit expense goes up. If you debit withdraw goes up. If you credit revenue goes up. If you credit equity goes up. Owner's capital goes up. Same thing, if you credit liability goes up. I told you also there is 2 methods of accounting, cash method and accrual method, right? Cash method is recording revenue or expense when the cash is received or paid, which is very easy, simple. It's good for very small businesses, but if you are working in a big company, cash method is not providing you a good picture. So therefore you use accrual method. Under accrual method of accounting, and accrual, I'm still thinking there's 2 R, I believe. Accrual, I'm kind of debating on that. But anyway, so accrual method of accounting is saying that you record revenue when you completed the job, provided service, and delivered goods. That is when you recognize revenue, not when you receive money, but when you earned it. And you also record expense when it is happening, when it is some sort of benefit has been received, when something has been accrued. That's why we call it accrual accounting, something accrued. That means, let's say you borrow money, 3 months later, what happened? Interest accrued, right? Because when you borrow money, 3 months later, you owe interest, obviously. For every month of borrowing, you need to recognize interest expense. So that interest expense is accrued. So in order to just learn that better, we have two types of adjustment, three types, let's say. We have three types of adjustment. We call it like depreciation expense, amortization expense. Depreciation expense, you use it for any capital asset that is tangible. You use amortization expense for any asset that is intangible. Let's say you want to amortize your patent. You want to amortize your franchise right. Those are amortization. You don't call it depreciation. Depreciation is for something that is tangible. The other type of adjustment is accrual. Accrual adjustment. So accrual adjustment, what is it? Accrual adjustment is an adjustment that no cash paid or received. No cash is paid or received, but something incurred / happened. So, or / accrued. Okay? So, accrual adjustment is an adjustment that you need to adjust at the end of the year, not because you paid cash to someone or you received cash from someone, but just because something happened. Let's say borrowing. Let's say you purchase a home and because of that purchase, a home or equipment or whatever, and you have a note payable. And that note payable, that means a liability. That means you have to pay interest. Maybe at the end of the year, December 31st, still you are not going to pay interest, but you have to recognize that interest incurred. You have accrued interest. Accrued interest needs to be recognized. And that's, we call it adjusting entry for accrued interest. There is another type of adjustment. We call it deferral adjustment. So in deferral adjustment, cash paid or received. So cash is paid or received, and we deferred the recognition of, expense or revenue to future, and future is the end of the year. So let's say you paid cash, prepaid rent to someone, and you deferred the recognition of rent expense to future. And today is end of the year, and you've been in that property for 12 months, so you need to recognize rent expense. Or someone paid you cash, so you received cash, and you deferred the recognition of revenue to future. And by end of the year, you go to management, you say, okay, you remember we have received let's say how much? $45,000. So how much of that $45,000 is not earned yet, or it's still liability? And the management says $2,000 still is liability. Then you say, okay, perfect, thank you. So I need to do this deferral adjustment. So cash received, we deferred the recognition of revenue to future, and now it's time to recognize that revenue. So based on those type of adjustments that normally we need to do at the end of the year, we go back in worksheet, and as you see in the worksheet, we have all our trial balance with complete balances at the top. Both sides are equal. And we provide some accrual adjustments, deferral adjustments, or depreciation expense recognition. So in this case, prepaid rent is an accrual adjustment. We paid someone $24,000, but all $24,000 has been used. So you reduce the asset by 24 to make it 0. And here you record rent expense. Depreciation, you record that $1,200 annual depreciation should be recognized for this equipment, because when you purchase the equipment, you capitalize it. You didn't recognize the expense for it. And now this is the way you recognize expense every year for next 10 years of useful life, whatever the useful life you can estimate. So here is $1,200. The accumulated depreciation will be credited as a contra account to equipment. So you don't touch equipment, you leave it the way it is, so people can see that the equipment original cost is $13,000, but it has been depreciated so far $1,200. That means the book value is $13,000 minus $1,200. That will be the book value of this book, which will be about $11,800 book value. So if you sell this equipment today, because the book value is $11,800 and you sell it, let's say, for $12,000, the $200 extra will be a gain on sale of equipment, and you need to recognize income for that. If you sell it for $11,000, then the difference of $11,800 book value and $11,000 sold will be $800 loss on sale of equipment, and you need to record a loss for it. In regards to unearned liability, unearned revenue, you received $45,000, so this is another accrual adjustment. So $45,000, but we have just $2,000 left from that liability. So definitely we need to adjust it by 43 to get to the 2 that we want. And in the same time, you record revenue, $43,000. So by doing all this, you see that at the bottom, both sides are equal, 68,200 on either side. So my adjustments, ideas are good, suggestions are good, debit credits are good. So let's try to see how my adjusted trial balance will look like. And by applying these 2 columns, trial balance and suggested adjustment, into adjusted trial balance in the worksheet, I can see that all my accounts are updated, and I have also equal sides on both sides. Okay? And that's where we did so far up to, yes, last time, up to here. Okay? So now we are going to complete this worksheet. And companies right now, they work with worksheet a lot. Why? Because they want, they are working remotely, and with having a worksheet, they can discuss the, adjustments and everything to see if something is missed or not. And even if they work face-to-face, still they use worksheet in their meeting to demonstrate the suggested adjustment to see if that makes sense to everyone, anything is missed or not. And if every time everyone says, you know, good job, then we continue to do the actual adjustment at the end of the year. So we are not doing actual adjustment right now. We are just thinking about it, okay? We are just doing brainstorm and working on a worksheet. Okay, let's work on prepare our a preview of income statement. So in the income statement, we have revenue minus expense. Agree? That's all you need in the income statement. So let's go to revenue and copy the income into the income statement. And copy expenses into income statement. Equals to, click on the utility expense, enter. Equals to, click on the rent expense, enter. Okay. And as you see, because I formulated at the bottom already, so my total expense is $35,200 and my revenue is 43. Remember, do you see all these are equal? 68, 68, 145, 145, but this is not equal, so it's not good, right? So what we're gonna do, just to understand what is our net income, so you go below expense. One more time, you go below expense and you say equals to revenue minus expense, enter. And voila, you have a positive number. That means your revenue is bigger than your expense. And your net income, okay, net income, if it's a negative number, you call it net loss. But because it's a positive number, you call it net income. So here we go. If it's a negative number, it will become loss. If it's a positive number, like today, it will become net income. Now let's go at the bottom, and I say equals to total expense plus net income, enter. It will be $43,000. So go to that box, grab the fill handle, and pull it to the right. And all that formula will be copied to the rest of the worksheet. So now you can see on my bottom section, you see, both sides is equal again. Nice, right? So here we go. That's my income statement. So I have a very good preview of my income statement. Any question for me, anyone? No? Okay, let's continue. So let's prepare the balance sheet now. So for balance sheet, I'm going to go ahead and copy all my leftover numbers in the adjusted trial balance into the balance sheet. So equals to $86,000, enter. This one equals to $13,000, enter. The other one, this is credit, right? Don't make a mistake. So equals to credit of $1,200, enter. liability is credit also, so equals to $2,000 credit, enter. Capital is credit. And there is one thing, withdraw here, equals to withdraw 12,000, enter. And highlight those two boxes, grab it and adjust it, or just highlight it and then double click and you will see it is adjusted. So it's too big, so I don't want that much space, so maybe that is good. Okay, so my balance sheet now is showing 111,000 and 130,000. Oops, is it equal? No, that's not good, right? So we have to make sure it is equal. And this is the very important part of this worksheet. This is the last moment that you check your own work. So watch carefully what I am doing and what I'm saying. Ready? Let's go. Here, first thing, look at your net income. Is it a positive number or it's a net loss? It's a net income? Positive, right? So, okay. If this is a positive, then go below smaller number in your balance sheet. Click under that smaller number and say equals to, click on that positive number, enter. If that number makes these both sides equal, congratulations, you did a good job. If not, you made a mistake, something is wrong. Something is very wrong. Now, imagine this is a negative number, like net loss, then what you do? If it's a negative number, you go below larger number in your balance sheet, okay? And you put it, copy it over there, and then add them up. And in that case, it makes it equal also. So that's the tricky part at the bottom. And this is where I'm technically checking my own work to see if I am doing good or doing bad. So listen to this carefully, because you have a project with your group and you're gonna do exactly the same stuff right now I am doing. Okay, any question, please? No? Okay, let me tell you how lucky you are that this is an online class. You know why? Because for many years, I didn't teach this online. So I told my students whatever it is in the classroom. Some of them were sleepy, some of them were, you know, excited about something else. And some of them even missed my class for that day. And God helped them to catch up what I said, right? And to remember what I said. So what you are doing right now, it's a very lucky situation because you can just watch this video forever, right? All day long, as many times as you want, just to make sure you can master this. So congratulations. Don't think everything has a bad side. So appreciate COVID-19.
Thank you.
This is a good lesson, that to understand that every single bad thing happens in your life, there is a good side on that. A good side. And that has been proven more than 100 times to me during my lifetime. And every single time I said, okay, what's the good thing about this now? And either a matter of few days or few months or few years, I realized, oh my God, thanks God that that bad thing happened. Okay? So the other thing is when something bad happens, don't focus on the bad thing. Focus on how you can make a lemonade from a lemon. That's the idea of living, okay? So this is a good thing about COVID-19. I learned so many things. I learned Zoom meeting. I learned how to teach this online in an effective way. Up to like about 8 months ago, if you asked me online accounting, I would have said my students will fail because it's very hard to teach this online. And maybe you don't believe me or not, but the summer class, I taught accounting, 2 classes, all of them 80 students in each, which is unbelievable because normal students is 40 in one class. But in summer, I taught 80 students in each class. I was teaching 2 classes. And those students, in my summertime, teaching something that I am teaching in 16 weeks, I taught them in 6 weeks. Okay, accounting 1A, 5-unit class. Normal 16 weeks, I taught them in 6 weeks. Online, 80 students each class. Those students, after so many years of teaching accounting, those students like literally ace my class. I got so many A's that I was thinking, am I doing something wrong? Because everyone is doing perfect. I mean, everyone. Barely I had few B's and few C's. Everyone was A. Every homework was done. Everyone was answering quizzes perfectly. Every test was okay. So the project was very good. Oh my goodness. So think about it. So this is a very good opportunity. Now that your worksheet is ready and everyone in your department, in your accounting department says this is perfect, let's do it. So let's take this as a source of reference and use these suggested adjustments and do the adjusting entry. So let's go and do it. So here we go. You see this adjusted trial balance? I'm not doing it, but bottom line, those numbers are coming after adjustments right now. But let's do adjustments for now. So here we go. What is the first adjustment that has been suggested in the worksheet? So let's look at the worksheet and see if I can come up with. Okay, I suggested that prepaid rent should be credited 24,000 and rent expense should be debited 24,000. So let's go. Doesn't matter which one you do first. So rent expense, it's a debit, equals to, watch carefully what I'm doing because the same thing you're gonna do it. So here we go. Rent expense equals to, you go to worksheet, and that will be rent expense here, that box. You see that? And that's enter. Cool. The other one is prepaid rent. Prepaid rent. It should be credited, so equals to, go to worksheet, and that's the prepaid rent credit, enter. And the other one, I forgot, so let's look at it. The other one is accumulated depreciation credit and depreciation expense debit. So let's do it. So accumulated depreciation dash equipment. Okay, that's Control X, Control V. That's going to be at the bottom. This one is depreciation expense dash equipment. Okay, so depreciation expense equals to debit, go to worksheet, and that's the box on the debit side, enter. And accumulated depreciation equals to, go to worksheet, equals to that box, enter. Remember, if this is a QuickBooks, in the QuickBooks, you go to click journal entries, then the window will open, and then there is a box somewhere here. It says adjustment, check that box. Checking that box, that means click on that box. Checking that box means whatever I'm doing right now is not a normal journal entry like this area, but is an adjusting journal entry. So QuickBooks has a box that you click to show it's adjusting journal entry. Here, I wrote it for you. I said this is adjusting entries on December 31st of 2014. You have to do the same thing in your project. You have to write it down so I see where the adjustments are. And let's do the next one. So the next one was about what? I forgot, so let's look at it. Unearned revenue debit and revenue credit. Okay, perfect. So unearned revenue or deferred revenue, the same thing, deferred revenue or unearned revenue. Debit 43,000, right? Equals to here $43,000. That box, enter. And revenue, there you go. Credit side equals to, go to the worksheet and click on revenue, that box. Enter. Now, remember, every single journal entry you do in a QuickBooks, you cannot do the next one until you save it, okay? So you click the box says save, and you post it to the T account. So let's post it, please, before we forget. So post this one, rent expense debit, okay? So here we go. We don't have one, so rent expense, which is account number what? Let's look in the worksheet, account number. There's no account number. It's okay, let's make up one. So we call it 640, okay? So 640. So in QuickBooks, if you don't have an account, you have to create an account. And you have to make sure that the account number is a proper account number that you want. Okay, so that's rent expense, and that's a debit, so equals to?
Rent expense is a 643, sorry.
643?
Yeah, it's rent expense.
Oh, okay, I will fix it. So let's go to rent expense here, debit rent expense, enter. And you said 643, let's do 643,000 here. Okay, so 24,000, but the prepaid rent here, you see that? It has to be credited, so equals to, go up and bring it from the credit side, enter. So now prepaid rent has a balance of prepaid rent has a balance of equals to debit side. Normal balance for any asset is debit side. That's why I'm on the debit side, okay? Minus credit side, enter. And there you go. It's a $0 prepaid rent, updated. Perfect. Let's do the another one. So go up. Yeah, next one is depreciation expense and accumulated depreciation. Okay, so do I have depreciation expense? No. Okay, so I create one. So this is depreciation expense, account number something, 612. Okay, and the depreciation expense will be equals to $1,200. Enter, and accumulated depreciation dash equipment account number, and that's let's see, 168. 168, and that's a credit. It's a contra account to equipment. Okay, so whatever happens to this, it's just like happening to equipment. So equals to accumulated depreciation. Enter, and then one more. Let's post this one. Unearned revenue and revenue 43,000. Okay, let's go down. I have revenue here with account number, God knows what. Let's see. Revenue 401. And unearned revenue, we have it already. So let's go. So revenue is 401. And that's a credit equals to normal balance for revenue credit. Normal balance for revenue credit. There you go. And unearned revenue, which should be somewhere here. You see that 45? So we're going to debit that to reduce it. So equals to debit unearned revenue of 43. Enter. Now I go to the, it's a liability. So the normal balance is so-called credit side. And I click that double line box, and then I say equals to that box 45 minus the big number minus the smaller number, and enter. There you go. That's the $2,000 balance on unearned revenue, and that's technically exactly what my management told me. Remember that? Here, line 6, it says unearned revenue balance should be 2,000. Congratulations. Life is so interesting, right? So here we go. So we prepared adjusting entries. So now all we need to do is just, you can prepare this adjusted trial balance if you like to. So those are all account numbers comes here, just like this one, but a little bit more than this. Why? Because you have some other new accounts that gonna be there, and the result will look like that. And the add up will be 146 to 146 2. That's what it will be. Okay, so you can do that yourself. Now that my what is it, the so-called adjustments are done, after adjustments are done and adjusted trial balance is ready, right, which is ready in my worksheet. Here I'm lazy, I'm not going to do this. So since this is ready, so what you're going to do, you're going to prepare your financial statements. So you're going to say, okay, for the year ended December 31st, 2014, my revenue, this is why you say for the year ended, because this is for the whole year. This is from January through December. This is the result of January through December, okay? That's why you write it this way. You cannot write another way. So here we go. How much is it? Equals to, and that is your revenue. So let's go to revenue. Sorry. Let's go to revenue, and my revenue is right there. Enter. You see that? And my expenses are, let's say, depreciation expense, right? And what else I have? Rent expense. What else I have? Rent expense, depreciation expense, and yeah, utility expense. Okay. So what are my expenses? Here we go. You say equals to. So my depreciation expense, go down to depreciation expense. It will be that box. Enter. Rent expense will be equals to rent expense, which is that, and utility expense, which is equals to utility expense, that box. Enter. So now this is the part. That box needs to be a $sign because it's the first number in the column, needs a $sign. However, the other two, they don't need a $sign anymore. Okay? And this number is the first number in the column, it's a $sign too. So now let's add them up. So total expense will be equals to sum of, don't worry about this highlight. You highlight wherever you want. So put your mouse on the first number, click on your mouse, push it down, let it go, and click enter. Done. Okay? And what else? So now that total expense is 35, so I go here, I say equals to my revenue minus my total expense, enter, which is 7,800, which is exactly just like your worksheet. Double line, $sign, net income. You can even make it cute like that. Okay? Now, for statements of owner's equity, the same thing. You say for the year ended December 31st, 2014, beginning balance, because it's a brand new business, so the beginning balance will be 0. Beginning balance 0. Owner's investment equals to how much plus owner's investment. So owner's investment goes up by 100,000. There you go. Net income equals to this box. So you go to that box, you see it's already formulated. Equals to this box, and it's jumping over there. So that's why this is number 1 and this is number 2. Okay? Cool? Now, subtotal is sum of those 3 boxes, enter. Less withdraw, so equals to less withdraw is that box, enter. My goodness, right? So what's the total now? Equals to 107 minus 12, enter. Okay, in regards to $sign, those numbers, they don't need $sign. They need to be regular so-called numbers. So like that. So first number needs a dollar sign, last number needs a dollar sign and double line. That's your end owner's equity. End owner's equity. So imagine this guy has a business the end owner's equity is 95,800. And someone at the end of the year comes says, hey, this is a beautiful business. I like it. I want to buy it. The owner says, okay, you know what? Give me $120,000. I sell this business to you. And he said, okay. So he buys this business for $120,000. Okay. The difference of $120,000 and $95,800 owner's equity, that will become gain, capital gain on sale of business. And next year, this owner has to show that capital gain on sale of business in his next year tax return. Okay? And the person who buys it, he paid $120,000 for some assets, right, of that business. Let's say the business has only, for example, how much asset? We will figure out. But let's say business has $50,000 asset. But all of a sudden, this guy purchased it for $120,000. $50,000 fair market value of assets, but he paid $120,000. The $70,000 extra he paid because of good reputation of this company, because of good location, good customers, good whatever it has, right? And we call that in accounting goodwill. So goodwill, you cannot have a goodwill unless you buy another business or another thing, and then you pay extra, and that extra payment at the top of the fair market value of the asset will become goodwill. So if you go look at the Disneyland financial statements, Disneyland is a publicly traded company. You look at the Disneyland financial statements, you will see Disneyland has a lot of goodwill. Why? Because they bought so many things overpriced, and the difference of fair market value of the asset and the cash payment, that would become goodwill. Goodwill in accounting, you do not amortize it. However, if after a few years you realize that that goodwill for some reason has been disappeared, and the company is not the company you purchased, is not the company it was before, you can write it down. You can reevaluate your goodwill and write it down and recognize loss on goodwill evaluation. And if you do that, you cannot reevaluate your goodwill back to wherever it was anymore. And you record loss on goodwill evaluation, and your goodwill dollar value will go down. Advanced accounting. But let's focus on this. So balance sheet is as of today, which is as of today only, 2014, okay? So how much asset do you have? Let's say you have cash, definitely. Cash goes at the top. Why? Is the most liquid, right? Most liquid goes at the top of the balance sheet. It's under classified balance sheet, cash is current asset. Current asset is an asset that can be converted to cash in very short term, 1 year or less. So that's a current asset. So cash, you say equals to here equals to $86,000. But then After current asset, let's say accounts receivable is current asset, supplies are current asset, inventory is current asset, prepaid rent is current asset. You don't have any. But after current asset is investment. If you have any long-term investment, that's what it comes next on the classified balance sheet. After investment, if you don't have any, skip it. After investment, it is PP&E, property, plant, and equipment. Property, plant, and equipment. Those are items, equipments, assets that you use in your daily business operation, like printer machine, furniture, equipment, building, land for your employees' parking lot. All those will become PP&E. So in regards to PP&E, you have equipment. So that's the next. So current asset, we skip investment, and now we are on PPE classification. So under PPE, we have equipment, and the dollar value equals to 13,000, enter. Dollar sign is very good. And then accumulated depreciation dash equipment. So accumulated depreciation dash equipment, and that's equals to that, enter. Okay, so let's draw a line. Is it a line? Yes, it is. So now this cute number has to go on the right side. So equals to equipment less accumulated depreciation. That's the net equipment. After PP&E, you have intangible asset, which in this case, we don't have any. Intangible asset like goodwill, like patent, copyright, trademark, franchise right. Those are all intangible assets. So 86, this one doesn't need a dollar sign, so let's get rid of dollar sign. So 86,000, so here, let's go to here, so total asset is equals to 86 minus net equipment 74,200. Okay, so what liability do I have now? My liability is unearned revenue. Unearned revenue, and the dollar amount is equals to, because this is a new section, okay, already I'm done with asset, double line, dollar sign, I'm done. So this is a new section, it's a dollar sign, definitely. So unearned revenue is here, $2,000, enter. And do I have any more liabilities? No. Okay. I took care of withdrawal also already, so the only thing is left is owner's capital. And okay, so owner's capital. So owner's capital equals to, this is where it comes from here. You see that? Comes from there. Owner's equity. It's a better name. Call it owner's equity. So enter. Owner's capital or owner's equity, that's fine. So that's 95,800. So this is number 3 because I have to do number 2 to get the owner's equity balance so I can make it make my balance sheet. So let's say total liability and equity. So total liability and equity is equal to that box. Something is wrong, but we will fix it. Plus that box, enter. So what am I missing? I'm missing something. You see, my balance sheet is not balanced. So I have cash, I have equipment, prepaid rent is 0, unearned revenue is 2,000, accumulated depreciation is 1,200. Oh, I made a mistake here. So here, 86 plus 11. That's my total asset. Okay, now it's good. So my total asset is $86,000 cash plus equipment gives me $97,800 total asset. And my liability is 2,000 plus equity, 95,800. It gives me $97,800 total liability and equity. And my both sides. So click on 97, push control, keep control pushed, click on 97, then click on the paint so you can paint it. Here we go. So my total asset equals to total liability and equity. Fantastic. So far we have been able to prepare financial statements. So what we did today is we finished our worksheet. Using the worksheet, we entered adjusting entries. We post them to the general ledger. Then using general ledger, we created all these numbers. Income statement is 7,800, which is exactly what my worksheet is showing. Owner's equity at the end of the year shows 95,800. And my balance sheet shows 97,800 total asset, which is equals to liability plus equity. And you see this owner's capital here right now doesn't look like 90. Is this 95,800? Do you see that? No, it's showing 100. But here is showing what? 95.8. So don't worry, hold on there. We will figure out this later on next time.